The sole purpose of the superannuation is to provide the retirement of the members after their retirement. There is no tax after the retirement on all the income.
So essentially it's a privatizing retirement, isn't it?
Good
in
point.
a way.
Absolutely.
Yeah. Obviously when super was first created, there wasn't as much safeguards back in those days.
All the concessional contribution that you sort of receive, those concessional contribution doesn't exist anymore, right?
You shouldn't be contributing as easily anymore because you've gone way over.
There's so much moving variable, but I suppose what Paul Keating's comment was, which I agree, right, that you got to start somewhere.
Hi everybody. Welcome to another episode of the Investing for Doctors podcast. I'm your host, Dr. B. And today we have Mr. Munzurul again to join us.
Thank you very much. Thank you, B. Thank you for having me.
Hi, Munzurul. So today the topic for discussion, where we've been talking about all the compulsory things in life.
Yes.
I think one of the previous episodes we talked about taxes.
Yes.
And now it's the next compulsory thing in life when you're an employee. It's about superannuation.
Mm-hmm. Mm-hmm.
So, most people who are employed will have superannuation. So tell us, Munzurul, why do we have this system in Australia?
Oh, lovely. Yeah. So, if we look back a little bit of the history, and this is I suppose, out of inquisitiveness and sort of curiosity as such, right? So it sort of goes back to all the way when Paul Keating was the treasurer, right? And we had Bob Hawke as being the prime minister many years ago in the 80s, right? So there were some actuaries maths were being done, and the maths sort of says that the lucky country that we say as being the lucky country is that unless and until we nurture, manage and protect this lucky country, it may not stay as that lucky. And what does that mean, right? This is where Paul Keating as a treasurer sort of came in with a bit of a maths and says that, well, we're becoming an aging population, right? And as time sort of goes on, our medication sort of improves, life expectancy increase, and because we're wealthy as a nation means that we're retiring relatively early as well. So and we're not having enough kids, right? And at that stage, so all of those means is that there are less working people and more people going into the retirement. So how do we manage and maintain and nurture that bit of the elderly generation when they goes into the retirement, where their retirement is still being protected and their lifestyle is being maintained, if not increased as such. So Paul Keating did a bit of maths at that stage saying that, well, whatever you earn overall is that if you were to be saving about 15% of your income that you earn, and if you were to be compounding that over the lifespan of, let's say, that many years that you start working, then the capital that you would be receiving on the basis of your life expectancy is that capital would be sufficient for you to manage and maintain your lifestyle. Now, of course, this was math being done 30 years ago, right?
Yeah.
And many things changed. Life
Absolutely.
expectancy
It's changed tremendously.
Many things changed, right? But that was a start. So this is where Paul Keating sort of came in as a treasurer saying that, all right, this is now mid-80s, and what we will do is that everyone will get a pay rise after this budget. Everyone is obligated to get a pay rise, and the employer is obligated to give a pay rise. And it started with 3%, believe it or not, right? So it started with 3%, saying that everyone would get a 3% sort of a pay rise as such, but this 3% will go back to the Provident Fund, will go back to the superannuation. So while the employer, rather than a $100,000 salary, now it becomes $103,000 salary. But as an employee, I don't get 103, I get 100, and 3,000 goes into my super.
Yeah.
And Paul Keating did a bit of math saying that over that period of time is that 3% will increase progressively. And our objective would be is that how quickly that we can come back into that 15% bit of a magic number that we wish to.
So was it always 15%?
It was in day one. It was being math. The actuary's math was being done is to say if we can reach into 15%, then we're good, right?
Yeah.
So right now at the moment, as you know, that
11.5.
Yeah, 11.5 is up until June 24, right?
Yeah.
But if we look at from 1st of July onward, it's 12%.
12%, yeah.
Right? So we're creeping into it. We're getting closer to it. Now, that 15% math is not being set in concrete because things change, right? I mean, well, the life expectancy increased means that arguably we need more. But on the other side is that did we have a wage growth? And that also has an impact, right? What is the definition of the wage growth? It's not so much the growth, it's the growth on top of the inflation.
Yeah.
Right? Did we have
so there's
all of
just so
those?
much moving variables, isn't
There's
there?
so much moving variable, but I suppose what Paul Keating's comment was, which I agree, right, that you got to start somewhere, that we cannot afford not to do anything. We got to start a bit of a retirement plan for all of us, right? And all OECD countries is that if you look through, they all have
Some sort of
different
retirement.
shape or form their retirement plan. And if we don't, the burden on the government would be so much in terms of this pension payment, right? And how does the government pay? So that's what the superannuation is. It's almost organizing your own retirement in your own way without having impact from the government.
So essentially, it's a privatizing retirement, isn't it?
Good
in
point.
a way.
Absolutely.
Yeah. And,
Absolutely.
And I guess back in those days, medicine wasn't as advanced as it used to be.
Yes.
So when I look back, even 20 years ago, people used to die of heart attacks quite early. And that's a very poorly managed condition. And, even now, that's still a number one killer in the country. But it's the amazing things that we can do after an initial heart attack. We can prolong people's lives for a lot longer. And I guess nobody ever thought about that, how life expectancy has just gone up so much
Absolutely.
in these 30 years.
Absolutely. And we tend to be retiring a little bit early as well, right? We tend to be retiring a little bit early. And that's why what the government is sort of saying is that saying that you'd see that we hear very often that superannuation is very highly regulated. And the reason why superannuation is very highly regulated, there is almost a vested interest from the government's point of view is to make sure that, yes, it is there. It's there for the good cause. And it's there, we call this concept called sole purpose test. Means that the sole purpose of the superannuation is to provide the retirement of the members after their retirement. That is, there is no benefits to be taken prior to it, with some very rare exception.
Yeah, there's some caveats to that. Yes.
Yeah, very rare exception, right? No benefits to be taken. It's just purely for the retirement side of it. Very highly regulated because of the protection. What the government has done, though, is that along the way is the government has given a whole bunch of incentive, right? Is to say, okay, this is your superannuation benefit, but we'll give you some heads up, right? We'll give you some supporting hand in terms of just to make it a little bit bigger.
Yeah, absolutely. And I guess the number one thing is that any money that is contributed into super is in a tax privilege environment.
That's right, B. So if we look through in terms of the tax privilege environment, right, what is the tax incentive? So superannuation has a standard tax rate of 15%. All contribution as an employer that we make is a 15% taxed within the super fund, yeah? Any investment income on the super fund is also get taxed at 15%. And if you buy an asset and if it's being sold and there are some capital gains, the commissioner sort of says, all right, we'll give you a 1/3 discount if you hold that asset for 12 months or longer.
So
that means it becomes 10%, right? And under the current rule, and I say that very often, every time I get a chance, I say under the current rule because the rules can change.
Yes, the rules can
right?
change, exactly.
Rules can change, but the rules have been around for about good 10
and they've been quite
years.
stable as well in
10
that
years.
regard.
Yeah, 10 years the rules have been around. And the rule says, under the current rule, that after the retirement, there is no tax. There is no tax after the retirement on all the income. As an individual, even if I have some income at the age of 80, I would still be paying tax at my marginal rate.
Yes.
Right? There is no discount because of, retirement from the individual, but the superannuation, there is no tax. So there are definite incentive.
Yeah. So obviously when super was first created, there wasn't as much safeguards back in those days. And so there were, you hear about these people with like 100 million in their self-managed super funds and that sort of thing. So I guess that's one of the examples where they changed some certain regulations because it was being abused outside of that sole purpose, right?
Very good point. Very good point. Because see, in one side is that, well, the commissioner is sort of saying is that, yes, we're encouraging you to build your super fund, right? And what is the definition of the encouragement? So there's effectively two levels of contribution that you make, right? One is that we call that concessional contribution.
Yes.
Means that the employer contribution, which we spoke about, the SGC, superannuation guarantee charges, and it goes from 11.5% to 12% of your salary, right? Your salary is 100,000 and you pay 12%. So that 12% is in addition to that 100,000. That's your superannuation. So that's one benefit. That 12% can go all the way to 30,000, right? And it changes. Like last year, as of 30th of June 2024,
27.5.
That's right. It was 27.5, right? Now you can do up to 30,000, and that entire 30,000 contribution is taxed at 15%. We call that concessionally taxed, right? You also have right B as an individual is to say, I've got a bit of savings, I've got my personal money, I'm going to put in a bit of personal contribution.
Yes.
And that is my own personal contribution, which is 120,000 per year, and you can do 3 years in one hit if you wish to. That means you can go effectively about 360.
Yeah, but that's drawing down your future contribution, isn't
Absolutely. And there is no tax benefit to this one, right? There is no tax benefit on the in, and also there is no tax liability on sort of when you are on the super fund. It doesn't get taxed on the super fund, but when you contribute that on the super fund, there is also no tax benefit you're getting. But the comment which you sort of say is that what is the other side of the equation, right? And this is why the government sort of creating this sort of barrier, because government saying because it is being incentivized, what the rich used to do is that before the safeguard, they used to just put in all the money in the super
you could just
fund.
put in as much as you want, and everything else is just left for your personal expenses.
And if you're taxed at 15%, right, or taxed at 10%, or there is no tax after the retirement, of course there is an incentive to put in more and more and more. So the safeguard is being created in terms of that numeric value and the cap, so to speak, is to balance it out, is to say, yes, we understand this is for your retirement, but it's not so much abusement of the tax system and sort of minimizing tax system. You've got a $50 million asset base, and you found a way to have your super fund having 30 mil and only 20 mil outside. That means that 30 mil, there is no tax on that income of 30 mil. That's why the commissioner is sort of saying, now this has gone overboard, right? So that's where that barrier has been created.
Yeah. Well, I guess, the concessional, there's a cap to how much concessional you get, and there's a cap to how much non-concessional you get.
That's right.
That sort of limits how much money you can put in over time. But there's also other caps, obviously, once you go over certain higher numbers in the sort of the millions, where they're saying, well, you shouldn't be contributing as easily anymore because you've gone way over.
That's right.
Tell us a bit more about that.
Yeah, that's right. And you've got that limit, right? And over that limit, all that basically means is that all the concessional contribution that you sort of receive is that those concessional contribution doesn't exist anymore, right? Now, previously there were no limit, and the commissioner sort of came in, I think it's about 2 or 3 years ago in the budget that commissioner came in initially was about $1.6 million sort of a limit, right? But it gets indexed over a period of time. It's sitting about 1.9 or a bit higher at the moment.
Yeah, something like that. Yeah.
It's sort of sitting, right? And that means up until that stage is that you're being concessionally treated, right? All that 10%, 15%, no tax that we sort of said is that it would be treated as such. Anything above that is that it would be taxed. Now, where it become a little bit, I suppose, silly is that when they're sort of first brought in, this is where everyone's sort of saying, hang on, very often it's the devil is sort of sitting on the detail. And what's the devil? The devil is that it's not so much of that value. What the law says is that the market value of the superannuation. And the definition of the market value, say, as an example, is that if you buy an investment property and it's in your superannuation fund, whether it's a self-managed super fund, right, means that investment property needs to be valued every year on the basis of what's the market value.
That's costly.
Right? One is costly, I agree. And second is that every time when you do a valuation, let's say you bought it for 1 mil, right? And let's say it's sort of gone up 4 years now, and it's sort of gone up to 1.3 for argument's sake, right? So you need to bring in that asset base on the setup account as 1.3 million. Yeah. Now, that limit where you get taxed is on the basis of net asset.
Yes.
So where the challenge comes in is to say, hang on, I understand that it is 1.3, which is the market value, but it's an unrealized valuation. I haven't really sold it. The market says I can sell it at 1.3, right? Yeah, okay, there's reasonable data to it, but there is no guarantee. But either way, I don't have the cash in my hand. but you as a commissioner, you
want
are
me to tax me on
taxing
that?
me
Yeah.
because it is a verb, right? So there is a little bit of an anomaly on the system at this stage, and there is an argument the commissioner sort of says that, look, we hear it, but you're not selling it because that's your choice. The other side of the equation saying, well, if that choice is being taken away, then we get it prohibited in terms of selling. Is that right from an investment? So there is a debate behind it, but the underlying concept, one understand. What the commissioner is trying to do, what the government is trying to do is to say that, well, we've done this maths, we need that much fund because we're giving a concession and the benefit. What is that right level of capital that you need where it gives you the retirement, but it doesn't become, I suppose, an abusement of the system?
Yeah, beautiful. So I guess to recap and get back to the basics, right? Right now, if you're an employee, everyone gets 11.5% superannuation guarantee from the employer. And make sure you check that because sometimes people get it wrong.
12 now from 1st of July.
Sorry, 12. Yeah, it's gone up to...
Last year was 11 and a half, you're right.
It's gone up to 12 now this year.
Yeah.
And so definitely check that. Like say myself, I got that wrong. There's this thing about if you go over the 30,000,
yes.
There will be some issues with that. For example, if a doctor earned more than say $300,000 as an employee,
yes,
in certain employers they will say, well, we only need to pay you up to the $30,000 and we don't have to pay you anymore.
100%. So there's two things. Brilliant question. So there's two sides to it, right? One side of it says that while you have the SGC, the 12% superannuation guarantee charges, is that the statutory requirement is up to the maximum limit, right? And the maximum limit is 30,000, right? So let's say if a doctor is sort of earning, let's just say $1 million, right? From 2 or 3 different sources, or one source is earning a $800,000 million, a certain amount of that the doctor is earning. As soon as you're over 30,000 in terms of that contribution with that 12.5%, the employer is not obligated to pay it. However, the comment comes in here is that this is still subject to negotiation.
Yes.
They're not obligated to pay it. It doesn't necessarily mean that you cannot negotiate this as part of your package, right? You can still negotiate it. And then comes in the other side of the equation saying, well, what happens if you pay higher than the maximum limit? Mm-hmm. If you pay higher than the maximum limit, it gets taxed, right?
Yeah.
And it does get taxed at sort of highest rate, right? So you do lose because it gets taxed at high rate. But the way I see it is that even if it gets 47% being taken away, you still got 53% left, right? So that's probably the first point that I want to raise, that yes, there is a limit to 30,000. The employer is not obligated to pay anything over 30,000, but it is not uncommon for people to negotiate still as part of that package, saying that he will continue paying 12% and I'll look after my tax in my own way. I understand it's tax detrimental.
Yep.
Over a limit, we don't lose our concession up until 30. We only pay that extra tax from 30 onward. Right? So yes, I'll look after this. That's point one. The second is that what the commissioner also tried to say is that, well, if your adjusted taxable income is over 250,000, then that 15%, which is the concessional tax rate, is too low. And the commissioner sort of says that it's too low.
Or rather, your discount is too high.
Discount is too high, right?
And so you look at it.
This is why the commissioner sort of says you got to pay an extra 15% tax. Now, it's a common discussion which I go through with many of my doctors'
Division
client.
293 tax. Yes.
That's right. Many of my doctors' clients that I go through that all the time, right? Munzurul, I've just done my return. I've got my notice of assessment. What on earth is this extra tax? Why am I getting an amended return, right? I mean, and we should communicate in advance. But the reason why it is that the way the mechanics behind it, you do your tax return, you've got your tax obligation, that's what you have, right? And then the system automatically does a calculation. That's why they call adjusted taxable income. It's not so much your actual taxable income. There's a whole bunch of things that they add away to it. Things such as if you've got negative gearing, they add that away. Things such as if you've got fringe benefits, they add that away. Things such as if you've got some other reportable benefits, they add that away. And once they add that away, if it's over 250,000, they charge an extra 15%. Now, when I speak to the client, I sort of say that, guys, first comment which I say, we never shot a messenger. I'm only the messenger. I haven't created the rule. I'm passing the message, right? I'm passing the message. There is no other way of saying it. it is an extra tax.
Yeah.
And there is actually no other way of saying it. It is an extra tax. Now, I'm not going to justify, but I'm going to give the rationalization from the commissioner. The rationalization from the commissioner is to say that, yes, your tax rate is higher. While we are increasing your rate from 15 to 30%, we're still giving you a discount, exactly what your point. We're still giving you a discount because you're not paying 47%, you're still paying 30% as opposed to 47%, which is your standard tax rate. So we're giving you a discount, but we're just reducing your discount, simply your income is higher. It's a hard conversation. Doesn't go very well with the doctors.
Absolutely. And it's the odd thing is that you're at that 47% when you're on 180, right?
Yes.
So between 180 to 250,
I know.
you get that. You get that extra, 30. 30
the super side of it,
30%, right? But
Yes.
then, once you hit over,
Yes.
that discount drops to 15%. So a lot of people just go,
And
"Ooh."
we look into planning side of it, B, right? And what we say as a planning side of it is that the planning sort of comes in is that if you're earning, say, 300, 400, 500, go and earn it, right? But if you're around that sort of, 240s, 250s, that that it would be very close, then I would much rather you sort of see whether you can be around that 248, 249, whether it is 251, 252, right? All within legal way, of course, of doing it, right? So there could be an element of planning, yeah.
And so that's a fantastic point. So now we've got the 12% that's compulsory from the employer. You get up to $30,000, and there's Div 293 if you go above 250 for everything added together.
Yes.
I think the point that you raised just now is that superannuation is actually an employee benefit.
Yes.
It's meant to be viewed as your overall earning package, of which you have to have a certain percentage of it being contributed compulsory to super.
Yes.
So just because suddenly your employer has hit the $30,000 cap doesn't mean the rest of your time is worth less. I think that's always the mindset to use when we negotiate these things.
Yes.
All right? Because it is money that is technically owed to us.
Yes, good point.
And it's just that the employer is paying that off in advance for you.
Good point. And if I look back from an employer's perspective as well, that any payment that they made, it's deductible, right? So from an employer's point of view, as an example, is to say
It's just
that,
a wage. It's almost like a wage that's accounted differently in a way.
That's right. It's a contribution and it's deductible. Means that, let's say if I had to pay 30,000 as an obligation, I paid it. But let's say that you negotiated with myself where, yes, your salary is higher and it's about 50,000 as a super contribution. I'm paying you 50,000. I actually get that as a tax deduction of that entire 50,000.
Yeah.
So there is no requirement from an employer's point of view saying that anything over 30 grand is that if you pay, we're not going to give you any deduction. As an employer, we still get the deduction, right? So they're not sort of off, so to speak, simply because that benefit reached in there. So sometimes it is negotiation. You're right.
Yeah. It's also about how you view it, I think. So one interesting thing I noticed is that because a lot of people might still have the 5-year carry forward concession.
Yes.
Which means that if you haven't used your 25,000, 27.5 and 30,000 concessional cap, and your overall super is still under $500,000,
that's it.
You can actually contribute backwards to utilize all of your excess. So
Absolutely.
I noticed that because in my last financial year, I actually had super contribution by the employer that was above the cap. And what it ended up doing is it went up backfilling all of the the excessive caps I can carry forward.
And you can do all of those as an active planning.
Yeah,
and the
absolutely.
active planning means is that when you sit down with your accountant, is that this should be a question to ask, right? Is that what is my carry forward provision, right? What's my carry forward balance? We all have MyGov access now, and if you go into the MyGov into your superannuation section, it actually tells you on a year by year, right? I mean, even if I were to look through about say 4-6 months ago, the system has become more sophisticated now, so it's getting more and more data being input, right? So it's still not perfect. Sometimes the information is not right.
Slightly delayed as well.
Yeah, and delayed, and it's not right, but it's getting better, and it's getting much better, right? So it does give you that information. Where that planning component comes in is that all that excess super contribution that you can provide as a carry forward, right? Two sides. One side is that, of course, there is a cash flow issue. Can I afford to use that as a cash flow side of it? Why do I say this? Because anything which I'm contributing at the moment, I don't have the accessibility to
away.
it for a good period of time, right? Until my retirement. What is the retirement? Retirement, whether it's 60, whether it's transition to retirement, whether it is 65 years old, right? But nonetheless, there is a period of time that I might not get access to it. So as long as you do that cash flow analysis saying that I'm okay for that fund to be departed, that's point number one. Point number two is that as long as we also do the math saying that, well, it's also good of investing into the super, what is the super fund doing with that money? Is it being invested in the right way? Once we tick away those two, then we come back and say, well, the benefit of doing this is that it's tax deductible, right? So whether it is, I mean, we've done this return the other day. I think the gentleman had like 100,000 or so that he sort of contributed because he sort of a whole bunch of reason there was not a lot of contribution, and everything is tax deductible, right? And in his case, it was perfectly worked out well because he sold a property and he's got a capital gain and he had some other level of income as well. So his income was very high on
nice.
that particular year as an anomaly out of the system, right? And because the income was very high as an anomaly out of the system, that carryback provision came in perfectly well. It reduced all of those tax obligations. So it is tax deductible and fantastic mechanism.
Yeah, beautiful. I mean, it's the when you know that these things exist, then you can strategize on how to utilize them to the most advantage.
Absolutely. I think the comment in here is that sometimes what we do is that as a younger sort of taxpayers, right? Someone who's sort of say late 20s, early mid 30s, even early 40s, we sort of look forward and we say, oh, okay, I'm not getting access to it until 60 and it's 20 years later, 30 years later, too far, right? So let's not worry too much into it, too far. And very often it's too far. We leave that as such. But the comment in here is that take it seriously. And the reason I say take it seriously is that this is, number one, this is your retirement.
And it compounds.
And it compounds, right? This is probably as asset protected that it gets. And if we do not do it in the right way, the compounding is a double-edged sword. And double-edged sword in the sense that if there is a right investment, compounds very well. But if it's a wrong investments and the investments are not there and or the cost is high, which I want to explain in a moment, right? If the cost is high and or means that your opportunity loss, so to speak, is also quite compounded. One example in terms of the expenses side of it, right, is that how many times that we look back into our industry fund and say that, well, what's our management fee? What's our running fee? What's our administrative fee? Very often we don't get to see it because the return that we receive from the super fund is a net return, which includes some of those costs.
Yeah.
Right? Whether we have a lot of say on those costs, but at least we can inquiry that, okay, what are the different products you have? What are the level of the historical growth? What are the level of the potential? What are the level of the cost? Second part of it is that knowingly and unknowingly is that very often we may have a whole bunch of bells and whistles on the super fund, which may or may not apply to us. Say as an example is that I might have some life insurance, TPDs, income protection, right? And, one argues that we all should have life insurance, TPDs, income protection. But on the other side is that we sort of say that, well, this particular client may already have a very massive life insurance somewhere else, and he may not necessarily need that duplication of the cost. Yes. So the comment would be is that have the interest on your super fund, review all the ingredients of the super fund, completely understand it. And if you need to speak to your accountant to go a little bit deeper to it, definitely do it, as opposed to leaving that only a retirement. I'll worry about it 2 years prior to the retirement. Could be too late.
Yeah, absolutely. I think it's something that you just need to get a grasp of early on.
Yeah.
And when you sign up with the first employer, right, pick the right fund. And know what that fund is, what the default is in that fund and what your contribution is going into. Yeah. And as you said, I think in a lot of these default settings, there's default income protection, there's default life insurance, and default TPD. And if you already have that elsewhere, it may not be the best place to
and
double up.
100%. And what happens B is that there's the experience, right? So say example, doctor goes work for here and there and there and there and many different places, right? And just have a little bit of interest, super there, a little bit of super there, a bit of a super there, a bit of a super
Got to
there.
consolidate it. Yeah.
All on a sudden, you may find that you got 3, 4, 5 different places that you've got super fund.
And you have all these little insurance products there.
And the management fee and the administrative fee and definitely the insurance products, right? So rather than having all of those, sometimes we even forget how many places that we have the super fund, right? So the objective would be is that consolidate all ideally into one place of your choice, right? But in one place as such.
Yeah. And there is a functionality on the MyGov website to actually find where all your super funds are. And there's a feature to actually consolidate them into the one of your choice.
Yes. And you've got this lost super, right? And this lost super that you can actually search it and say that, do I have any funding in the lost super, right? And you'd be surprised how many times that we go in the lost super with all of our full knowledge, right? We still sort of find, I didn't realize that I've got that much money sitting in there.
Yeah.
Could be 10 grand, could be 12 grand. But it all adds away in the right way.
Absolutely. And I think there's another thing I really want to add is that, we've spoken about this in a previous podcast. You check your payslip, make sure you're being paid right and paid on time. Because if you're not paid right and you're not paid your overtimes or on time with some of your claims, you're not getting paid the super on top of that as well.
Good point.
And when that's not paid, you lose the tax benefits and you lose the time in
Good point.
money.
Good point. There's so many different elements that you just touched, right? So many different elements. Number one is that you paid in time. So you're supposed to get paid every quarter at a bare minimum, right?
Yeah.
So at the end of each quarter. So you must get paid at the end of each quarter. So if you don't get paid on this particular quarter and let's say employer for whatever reason paying that 3 months later, 6 months later, you're losing the income of those 3 or 6 months. One point, right?
Thankfully, in most health hospitals, we get paid on the same fortnight. We get paid.
Love it.
So you get that time in the market.
Love it.
Yeah.
Love it. And the second thing then is that for whatever reason, let's say that you're right at the end of June, right? And it didn't get paid prior to the June and it got paid on 5th of July or so. You still got paid, but all of a sudden when it got paid on 5th of July, it counts for your next year's limit. Right? So you may find yourself in a position where this year's limit is lower and you've got this unused amount and all of a sudden you're paying extra into the next one, right? So one needs to take that into account.
So the good thing is that because now we have that 5-year carry forward, it's not as painful. But if you're already over the $500,000 cap, make sure that gets 100%. Utilized.
And the third comment is that B also is that what you touched, right? Is that if you've got overtime, right, and you've got that extra bit of the time and so is to ensure that yes, we are getting superannuation payment in there, right? Because the superannuation on the overtime is that it's not so much
not guaranteed, is it?
That's right.
Yeah.
It's not subjective, but it is. It's also not guaranteed in the sense that you've got a whole bunch of rules and regulation that if you fall in there, then yes, the employer is obligated to pay the super, and for this, some of the exception basis, the employer doesn't need to pay the super on your overtime. So your default would be is to say that, well, I would be entitled to, unless and until I'm being proven why I'm not. So if you see that there is no super on your overtime, we ask the question to the employer, why isn't there, right? But we check them. So you're right, on the overtime side of it, we need to check.
Yeah, it's and like the last time I brought out a pastry, one of my colleagues, I showed you, it was so complicated. So it's, read your timesheets. I think that's important.
Taking that interest on the super. This is genuinely, it's like a small plant, right? Which sort of grows into bigger and bigger and bigger. And one day it become a large tree. But it will become a large tree if we nurture it in the right way. So all of those things, right? Number one is to have the general knowledge. Number two is to make sure that whatever we are entitled, they're all coming in the right way. Number three is to make sure that the taxes are getting looked after in the right way. We're not unnecessarily paying extra tax. Number four is to make sure that my super is not getting taken away by a whole bunch of unnecessary cost or inefficiency in terms of having 4, 5, 6 different super fund, right? Consolidating. And then number 5 is that we sort of say the investment of it, how it is being investment, right? And that investment journey that we review every year. I'm not a financial planner, can't give the investment advice, but as an individual taxpayer, we must look into it. What are the returns? What are the growths? Where is it being invested? How it is being invested? Get a financial planner to review. Many of those larger super fund, they have their in-house financial planner.
Yeah,
At a bare minimum,
absolutely.
if we could just take a consultation for them.
Yeah,
right?
and it's free.
It's free, right? So we've got all those 7 different investments as such. At the moment, I'm sitting on number 2. Now, I understand it depends on my risk profile, that whether I'll be on sort of a lower level of the risk, higher level of the risk, higher level of the growth potential, understand on the risk profile. But I have that chat with the financial planner side of it.
Yeah, absolutely. I think that's a conversation we'll have in the next podcast,
Sure.
and to go a bit deeper into
Sure.
how superannuation works and how it ticks. But yeah, so basically superannuation, it's going to be part of everyone's life
Yes.
as long as you're employed. If you're not an employee, don't forget to contribute it because that's something a lot of people forget to do as a sole trader. You just keep your money in your bank account and you forget about this very important facet of your financial well-being. So thank you everyone for listening. Thank you, Munzurul, for joining
thank you
us.
very much.
And we'll wrap this up for the topic on superannuation basics.
Thank you very much. Thank you.
Thank you, Munzurul. This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.